As far as what government does or doesn't do, that pretty much doesn't matter. There's a reality bigger than that, okay? And a lot of people think markets go down because something happens. Most markets, when they go down, have big bear trends. It's because of what already happened, built up over years. And the market is expunging itself of that error, overpricing error, assumptions that were false errors. And we've had the biggest bull market in U.S. stock market history from 2009 to 2005. And it was led by the tech area. NASDAQ 100 went up 18-fold in 15 years. S&P went up about 8 or 9-fold. So clearly NASDAQ 100 tech sector was leader. But you say, well, that was a good, strong economy. Well, of course, Trump would admit that because most of the presidents during that time were Democrats. So you look at an M2 chart, Federal Reserve money supply. It's vertical, okay? And basically any 10-year period you pick going back to the 1950s, the money supply went up 90 some odd percent, almost double in quantity. Okay, that means given the greater quantity, it has less real buying power. And sure enough, since I was a kid, the loaf of bread was 20 cents, now it's, 10 times or 15 times that. Is it because we have a wheat drought? No. It's because of the ongoing degradation in the real value of the money units, not just dollar, but euro, yen, you name it. So that's a major fact. And these things are in play. So as far as the economy goes, I think we're at one of those points now where the bubble is starting to break, stock market. We gave a sell signal for the S&P in early January. That was just short of a high it made in February, and then it dropped hard into April. We know that in any trend, there are counter trend rallies. But when it was on its way down to 4,800 price level, which was our target for a bounce, not a bottom, a bounce. The bounce has been bigger than we thought it might be because it went up and made a new high. But that was a level where we thought there would be support, and lo and behold, the crowds came in. We point back in our reports recently that we've been around since 1992, but in 2000 dot-com top, MSA called the top in January. But golly, if you look at the price chart of the S&P, it made higher highs in March after we said sell in January. There was a sharp drop, then it came back up in March, and it labored all year, comfy, either side of our get out point. Finally, in 2001, it started to cave, and in 2002, collapsed. In fact, the NASDAQ went down 82%, a near wipeout. Then 2007, another arduous top. Close of 2006, the S&P was about 1350 in price. We projected that we'd go higher in next year into 2007, and we had a target for a top. We defined it as 1550 to 1600. Now, I'm throwing out numbers here. Let me tell you what those are. 1550 was the old high that the market had made in the year 2000. So it was at 1350. We said, we're going to go back to the old high. We're going to take it out. And that's where you're going to top. Well, in May, we went up over 1550 by about 2-3 points, matching the high in 2000. And they sold it. Sharp sell-off into the summer of 2000. This is all during the building mortgage crisis that was increasing in its lethality. Not recognized by the Federal Reserve, but nevertheless, it was going to happen. Then in September, the Fed cut rates. September 2007, right in the middle of the month. It was a surprise rate cut, 0.5 point. Even though Bernanke back then said, no problem with the mortgage market. It's under control. Well, why'd you cut rates then? Okay. Market went up into October, stopped at 1576, precisely in the middle of our target zone. That was it. Arduous. In other words, tops in the stock market are often very time-consuming and teasing. Often with, even once momentum breaks, prices, no, I'm going to go for more. It doesn't, but it makes that new high. I think that's exactly what we're doing now in the U.S. market, is we've teased out the high of early this year. And by the way, if you look through the market more carefully, not just the S&P or the NASDAQ, many sectors, many key symbols, including the Mag 7, aren't making new highs. A couple of the Mag 7 are, but most of them are way off the highs now. So the leadership has been decimated, and it's not exactly what the S&P and the NASDAQ charts seem to be saying. We think it's a top. It's important for silver and gold, because when that money flows out of there, and it's already begun to, seeking an alternative place, monetary metals will be the prime area. Gold is already reflecting that, and we think that silver is about to take control and vastly outperform gold, and probably much of that you're going to see in the next 5 to 6 months.
Let's be honest about something up front. A lot of people are still clinging to the illusion that what the government says or doesn't say is going to dictate the fate of the markets. That some announcement, some policy tweak, some rate hike or pivot will move the dial. But what they fail to realize is that we're not in a cause and effect moment. We're in the inevitable aftermath. What's unfolding now in the financial system isn't about what's going to happen next quarter. It's about what's already happened over the last decade and a half. What you're seeing now is the unwind, the expulsion of excess, false assumptions, and egregious mispricing that have been building up since 2009. And yes, it was a bull run for the history books. From the ashes of the 2008 crisis, the U.S. equity markets were inflated into the most extreme valuation bubble we've ever witnessed. Bigger, broader, and more tech-focused than anything we saw even at the dot-com peak. The NASDAQ 100 went up 18-fold in 15 years. That's not an economy doing cartwheels. That's a monetary distortion of historic proportions. The S&P itself rose about 8-fold. You don't need to be a technician to understand that something was off. You just need to ask yourself if the world really got 8 to 18 times more productive since 2009. Spoiler, it didn't. This entire move was built on the vertical expansion of M2, the money supply. Anyone who's looked at a chart of M2 over the last 15 years knows what I'm talking about. It looks less like an economic indicator and more like a ski jump. We've never had a slope that steep in recorded monetary history. In any normal 10-year stretch going back to the 1950s, you'd expect M2 to double, give or take. But in this era, we blew through that with rockets attached. And when you double or triple the money supply while production and productivity are lagging, what do you think happens? The value of that money unit crumbles. That's not a theory. That's just arithmetic. A loaf of bread that used to cost 20 cents when I was a kid now costs $5. And we're supposed to believe that's normal? That it's the cost of doing business? Number, that's monetary rot. And it's not just the dollar. The euro, the yen, the pound. They're all playing the same self-destructive game. That's the macro stage we're now performing on. It's not just a weak link here or there. It's systemic. So when I say the stock market top is already in, or very close to it, I don't say that because of some tweet or CPI print or jobless number. I say it because the foundations are crumbling, and you don't need to look far to see it. We issued a sell signal on the S&P 500 back in early January. At that time, it had just missed making a new high. Then it dropped hard into April. But here's the thing, every real trend includes counter-trend moves. Even bear markets have rallies, and we expected one as the market approached 4,800. That was our level, not a bottom, just a bounce zone. And right on cue, the market rallied, stronger than we initially thought, sure. But to us, it was within character. After all, we've seen this movie before. In fact, let me take you back to 2000. We called the dot-com top in January of that year. But if you looked at the price chart, the S&P kept chugging higher into March. Investors were euphoric. More highs, the bubble's not done yet. Except it was. The market stumbled through 2000, then collapsed in 2001 and 2002. The NASDAQ, down 82%, a complete wipeout. If you blinked, you missed the exit. Same pattern in 2007. In late 2006, the S&P stood at 1350. We projected that it would rally back up toward its previous 2000 high at 1550 to 1600. And guess what? It did. By May of 2007, it was hovering just above 1550. The euphoria was back. And then reality intervened. The housing crisis had been metastasizing quietly. The Fed, of course, denied it. In September, they cut rates by surprise. A half-point drop right in the middle of Bernanke saying, "Nothing to see here, folks." The market got one last breath, rallied into October, and topped at precisely 1576. Our target zone nailed. Then came 2008. Do you see the pattern here? Big tops are not events. They are processes. They unfold slowly, teasing investors with higher highs, only to drop the floor when they least expect it. Momentum rolls over long before price does. And when price catches up, it's often too late to get out with dignity. That's where we are right now. The current S&P action looks eerily similar. We've got this double top structure. The index tried to reclaim the early year highs, maybe even poke slightly above. But internally, the story is crumbling. Leadership has been annihilated. Look beneath the surface. Look at the Mag 7. A couple of them are making new highs, sure, but most are miles off their peaks. That's not strength. That's rot under the hood.
I guess really what is driving the momentum with the silver price?
Well, it ran up last year in 2024, early in that year in March. We put out a major renewed buy signal on gold and silver and the miner. Renewed meaning that for prior couple of years, they've been in pause mode. Silver and the miners had been staircasing down in corrective mode. Gold was going sideways, basically, capped at around 2,000. We said back in March of a year ago that we're going to take off again. And sure enough, they did. Okay. Silver actually at one point in that rally outpaced gold pretty nicely, but it didn't last, okay, in terms of relative performance. Silver ran up in May of 2024. In other words, a handful of months after our signal, and got up it was at our time of our signal, it was $25, $26. It got up to $32.70 a year ago in May and dropped from there. Came up later in October, got to $35, new high. Gold was going sideways, dropped again, went back up in March of this year again to 35. And that's when they had that panic sell-off into April, where investors wrongly thought that if the stock market goes down, silver must go with it. Gold didn't drop much during that time, but silver was punished severely. We know that 35 to 27.50, much of that in 2.5 days. Then it exploded right back over 30 and has worked its way up. Now we're at 37, either side of 37 for the last several weeks. That process in price where we basically, you could draw a line sideways from May of last year through a month ago. We've been above it and below it, but basically just violent oscillations. So it was really sideways. That was a corrective pause in price. And for momentum, our long-term momentum, it had a corrective pullback, where on the momentum chart, you could see a tube where momentum readings just kept zigzagging but downside in this very clear technical tube, parallel channel. In June, early in last month, we crossed up through that momentum channel. Price wasn't making a new high, wasn't back above the 35, but in the 34s, momentum said, I'm out of here. Boom, got up to 37 now recently. So it's broken out. That is the beginning of what I think is likely to be a couple quarter long, 5 or so months of upside, and likely to be very aggressive. Similar behavior occurred back in 1979 when silver exploded to 50. Also in 2010, the $25 to $30 level before silver exploded to 50 again. We argue this time, this breakout will render highly likely another aggressive move, but one that will not pause at 50. We think this one is going to get its first pause in the 60 to 70 zone, well above the old idiot highs. I call them idiot highs because really you didn't spend any time up there. It was like phantom, it was like a day or two. Thin air. I think by going through 50, which is not technically important for us, but it is for anybody looking at it as a stupid price chart, it's, all-time new high. In real dollar terms, if silver were to match those $50 highs, it'd probably be $300 an ounce in real dollar terms, underlying decay in the money unit. But I think that's likely to occur in the next 5 to 6 months, that phase. That is not the end of the bull. That's just the next thunderbolt. And during that time, I think silver will basically double in relative performance to what gold does during. Silver is definitely going to be the better place.
Let's get straight to it. This isn't a normal correction in equities, and it won't resolve with a soft landing. The structures we're looking at, the momentum signals, the sector rotation, the decaying internals, they're not just warning lights. They're the fire alarm. The final stages of major bull markets don't end with fanfare. They end with fatigue. And that's exactly what we're seeing now. Go look at the charts from 2000, or 2007, or even 2021. The market doesn't roll over all at once. First, the breadth collapses. You get deterioration underneath while the indexes hold up, because of a few big names doing all the work. Sound familiar? The Mag 7 are not a monolith anymore. Apple and Nvidia might still be carrying the torch, but Amazon, Tesla, Google, these are not making new highs. The illusion of leadership is cracking, and when the generals start to fall, the whole army retreats. But let's focus on what comes next, not just in stocks, but in where capital moves when it flees. And this is where it gets interesting, because when you think about what people own today, what they think is safe, you quickly realize they're cornered. Bonds, still toxic. They had their super cycle. That's done. Real estate, illiquid, bloated with leverage, and cracking in commercial corridors across the globe. Crypto, too unstable for institutional money. So what's left? Gold, silver, real assets, but especially silver. And here's why. Gold already moved. It's been sending signals for months now. It didn't wait for Wall Street's permission. It broke out against every major fiat currency long before the mainstream caught on. But silver? Silver is the shadow. It lags until it doesn't. And when that turn comes, it's not linear. It's violent. It's price reversion with jet fuel. We've talked about this before. Silver's behavior is unique. It doesn't gradually grind higher like gold. It coils, builds, then strikes. The kind of moves it makes aren't 5% or 10%. They're 30% in a week, 100% in a quarter. That's the emotional side of the silver market. But don't confuse that emotion with randomness. The structure has to be there. And now, it is. Remember what we discussed in part 1. The year-long sideways action from May 2024 to mid-2025. All that chop around $32 to $35? That wasn't trendless noise. It was structure building and momentum. A parallel tube, a channel of internal correction, correcting long-term overbought conditions without collapsing price. That's the ideal setup for a breakout. And that breakout already happened in June when we tore through the top of that momentum channel. Price hadn't even tagged $35 again yet, but momentum had already left orbit. That tells you everything. When momentum breaks out first, price will follow. And it has. Silver is now comfortably in the $37 range, hovering, digesting. But don't let that lull you. This isn't consolidation. This is the breath before the sprint. It's what markets do when they're preparing for acceleration. And let's talk about $50 because that's the number everyone's watching. It's the old high. It's the psychological anchor. And in our view, it's meaningless. Yes, it's the nominal high from 1980 and 2011. But those were both fleeting peaks, phantom prices. You could barely trade there. They weren't sustained. They weren't built on structure. They were emotional spikes. This time, we've got structure. And that means when we take out $50, and we will, we're not stopping. We're not pausing at that number to admire the view. We're going straight through, likely to the $60 to $70 zone. That's where we see the first real test. The first place where sellers might show up in size, but again, that's not a top. That's a waypoint, a rest area on the highway, not the destination. Why such conviction? Because everything is lining up. Momentum, structure, macro, and most importantly, capital behavior. As the equity markets wobble, people are starting to look for alternatives. Quietly, carefully, but it's happening. They're not broadcasting it. But the rotations in gold ETFs, in silver bullion sales, in mining stock volumes, they're there, like early tremors before the quake. Now let's go deeper. What makes silver different this time around? For one, industrial demand is no longer just a background feature, it's becoming dominant. Between photovoltaics, EVs, battery tech, and green energy infrastructure, silver is now foundational. And the supply chain is thin. Investment demand is the accelerant, but industrial demand is the floor, and that floor is rising. Second, the above-ground inventories are thinning. We're seeing COMEX vaults shrink, physical premiums rising again, India and China hoarding silver like it's the last ship out of port. They know what's coming, and they're not waiting for the Western financial press to catch up. Third, monetary policy. The Fed may keep up the tough talk, but everyone knows the tightening cycle is over. Even if they hike one more time, the direction is clear. The next move is down. And when rates fall, when real yields go negative again, silver will already be moving. Remember, silver doesn't wait for confirmation, it anticipates. And by the time the world realizes what's happening, silver will be up 30%, maybe more. That's how it works. Now let's talk about the miners. This is where the leverage is. The gold and silver mining equities are still hated, still undervalued, still flying under the radar. But that's changing, slowly. Names like Silvercrest, MAG Silver, First Majestic, they're all starting to get accumulation volume. The big boys are dipping in, and once the breakout is obvious, you'll see the re-rating. The juniors? They'll go vertical, as they always do, because nobody owns them yet. They're still radioactive to institutions, and that's exactly where you want to be, where capital isn't yet. So how do you position? First, stop thinking in price terms. Price is a lagging indicator. Structure and momentum tell the real story. And that story says, silver is now in phase 2 of a major bull market. We've completed the base. We've broken the ceiling. Now we run. Second, get exposure now, not later. There will be no elegant pullback to wait for, no gentle invitation to board the train. You'll either be in or you'll be chasing. The opportunity window is narrowing. Every day that silver holds above $35 builds a new layer of support. And once $40 gets breached, $50 will come fast. Then it gets fun. Third, understand your risk. This is not a low volatility play. Silver is emotional. It shakes weak hands. So size accordingly. Know what you own, why you own it, and what your exit looks like. Don't flinch. Don't micromanage. Fourth, think long-term. This is not a quick trade. This is a cycle, a monetary cycle, a generational reset in value. That doesn't end at $60 or even $70. That ends when the monetary system is forced to acknowledge that fiat dilution has consequences and that gold and silver are still money, no matter what the central planners say. I'll close with this. Markets behave like people. They laugh, they cry, they hesitate, they leap. But most of all, they remember. They remember what works. They remember what holds value when everything else breaks. And right now, the market is remembering silver. This move will define careers. It will reshape portfolios. And for those watching closely, it will confirm everything we've said for the past year. So watch the structure, trust the momentum, and be there when the thunderbolt strikes, because it's coming, and it's coming fast.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.